Welcome everybody to Interactive Brokers webinar program. This is Andrew Wilkinson, Director of Trading at Interactive Brokers. I am delighted to have with me today Brian Rauscher, CFA from FSInsight, one of the research providers on the Interactive Brokers platform. We'll talk a little bit more about that later in the session. Just a couple of items of housekeeping. If I just want to do a quick sound check, make sure everybody can hear me. If you could just type, there we go. Thank you, Andreas. Always reliable, loud and clear. Thank you very much. So if you have questions for Brian, please hold them to the end of the session, and I'm going to try and do a Q&A after Brian's presentation coming up. And I will also show you later in the session how to access the research if you are an Interactive Brokers client from the Trader Workstation. But without further ado, I'm going to hand the mic over to Brian Rauscher, who is the Head of Global Portfolio Strategy and Asset Allocation at FSInsight. And welcome, Brian. He's going to talk to us today about his 2021 portfolio strategy outlook. Brian, welcome.
Hey, Andrew, thank you very much. I really appreciate that. And thank you, everybody, for making the time to participate today. We have a lot of material to cover today. I'm going to cover a little bit about my methodology and how we think and what we bring at FSInsight. And I guess what everyone is dying to hear about is, kind of what we're thinking about markets, potential positioning, either at the sector level or all the way down to the stock level. And we'll certainly get through that as well. So hopefully we'll have an exciting session here, and let's get started. So on the presentation, one of the things we're going to talk about, the name of my presentation today is Transitioning to Recovery, Further Gains Ahead. So I like to always get my presentation started off with a little graphic or something to kind of get us started here. And as we came into this year, I speak to a lot of clients institutionally around the world, and really people were in one of these two camps. So before we get started, I just want to know, you ask yourself, which are you? Are you in a half full camp, or are we in a half empty camp? And I think it'll be pretty clear when we get this through this presentation, which camp that I'm in. Despite all the negative issues that are out there, from COVID to the economy still being locked down and some of the other issues that we're dealing with, our research clearly shows that being optimistic is really the way an investor should be viewing the market right now. We've been viewing the market as a great setup for investors to make returns. We've been that way for most of 2020. And we come into 2021 with that same outlook. So why are we optimistic? Well, number one, and I've been talking about this for quite some time with my clients, but it's our view that we are in the early phases of a major corporate profit recovery. And this should really be one of the biggest drivers toward helping the equity markets move higher during the coming year. The second point is we have some proprietary models, and you might hear some new terminology today, which I'll try to explain along the way. But we have a proprietary, what we call earnings estimate revision model. And that model is the basis for a lot of what I do. And one of the things we're seeing right now is that it's very broad-based and favorable right now. And this generally is a good setup for equities to move higher. The third point, we still have unprecedented monetary and fiscal stimulus. Do not underestimate the power of this, and you may have heard the expression, do not fight the Fed before, and that's certainly the case that we're thinking about right now. When we put these 3 points together, it has historically been a quite powerful combination, which has been bullish for the equity market. So we are optimistic. We do think that the market has higher highs to go. What are our macro assumptions, behind, what we're thinking today, and how investors should be thinking about the market? So what I laid out here are some of my main macro assumptions. So the first one is our expectation is that the U.S. economy will likely grow between 3.7 and 4% this year. I will say that my assumption here is that we only had a moderate fiscal stimulus package. Right now in Washington, what we're hearing is that the Democrats that are controlling our government right now are talking about closer to a $2 trillion package. My expectation here was only for a $1 trillion fiscal stimulus package. So what does that mean? There's probably risk to the upside in my number, which would again can bode well for the markets. Number two, we believe that there's going to be a global synchronous economic recovery. Why is this important? Is our research shows that this should help cyclical and value-related areas, not only in the U.S., but also in other countries around the world. So this may be a good time to do some investing outside the U.S. When it comes to the U.S. dollar, it is a consensus call in my industry that the U.S. dollar will be weak. So although I like to be contrarian and go against the herd as much as I can, on this one it is a little bit hard. I also expect the U.S. dollar to weaken. That is important because that'll have some positioning implications, which we'll discuss a little bit later. I've also been expecting inflation expectations and interest rates to drift higher. Interestingly, as we start to see the headlines over the last week or so, as we're seeing interest rates beginning to drift up now, this is something I've been talking about for 5 or 6 months. So when I was out of consensus, everyone was a little bit curious why this would happen, and now it's here. We do think that interest rates are going to move higher. We also believe that the Fed will probably remain on hold for all of 2021. You may see some headlines from time to time that markets and fixed income investors do some rumblings that they should be tightening, that maybe the Fed is behind the curve. We may have bouts of interest rate pressures to the upside like we've seen over the last 5 to 7 days. But ultimately, we think that the Fed put will be in full force this year, which will be, again, another strong underpinning for this market. So that's kind of how we see the bigger picture. Economies reopening, COVID beginning to move towards the back page of the newspaper, and policy. And this has been a good mix for equities historically. One thing I always like to talk up front is, what might be the biggest fear for the year, or what may be a problem spot that we have to keep our eyes open for in case, what we're expecting does not unfold. And some of the fears that we have for the coming year, and by far, as I have highlighted here on page 9 in yellow, my big fear, and it has been my fear since I initially turned bullish last March, is that we get this perceptional shift in the market. And what you may start hearing about is rising inflation numbers, a Fed that may be behind the curve and has to start to tighten policy, and if we get what I'll describe as a disorderly upward spike in interest rates. Now, over the last 5 or 7 days, we've gotten a little bit of a taste of this. I believe, based on my research, that it is premature, and this little episode here will pass. But later this year, early to 2022, is my expectation that it'll really come to the forefront, and it will probably cause some problems for equity investors. So we're going to keep our eyes open for that. And for people that are remember the market, think back to what happened in the fourth quarter of 2018. We had a situation where Chairman Powell of the Fed was raising interest rates a couple times, and the market shifted to a very severe Fed tightening schedule for 2019. The consensus at that time from the economist community that the Fed was going to tighten 7 times in 2019. As we know now in hindsight, none of that happened. But equities reacted to that, and they sold off pretty hard. We're going to be looking for this as the year unfolds and see when we may have to take some steps to protect our portfolios and maybe move to a more defensive posture, but that is not for now. Second point, we may be moving past this. I wrote this several weeks ago and have been updating it. If the COVID cases don't look like they're disappearing and keep coming down, if for some reason we get the so-called fourth wave and COVID cases continue to go back up again, and the nationwide vaccine deployment continues to be on the slow side, that could be a problem. Markets, I don't think, would like that. The economic reopenings would probably become at a very slow pace, and I think that could cause some problem for the market if that were to happen. Something that right now markets don't really appear to be focused on too much, but it is something that we should keep our eye on, is what are some of the policy agendas of the new Biden administration? Could they bring up something that the markets will not like? There are a couple that really come to mind as the change in corporate tax policy. Could they be changing the taxes on capital gains and the like? These are things we're going to have to keep our eyes open for, because those types of things, again, could present some bumps in the road for the equity market and for potential returns. And then lastly, at this point, looks like it may be going away, but if we had kind of a continuation of some of the social unrest that we had last summer, if the U.S. would continue to be very polarized and we see headlines in the newspapers and the like of violence and confrontation with police and the like, that may spook markets a little bit. As of now, that appears that is not going to happen. But again, we always like to keep our eyes open for things that may disrupt our base case view. So those are things we're going to be keeping our eyes on this year. And obviously in every calendar year, there's always something new that pops up that no one's expecting. So we'll also be looking for whatever that unexpected event will be this year. So what are our bigger picture conclusions as an investor? When I do my presentations, before I get into some of the charts supporting our views, I like to give you what the conclusions are right up front. So the first thing we want to talk about is a U.S. investing versus investing outside the U.S. So one of the things that we've had is we have been very overweight the U.S. versus the non-U.S. world for the last 3 to 5 years. One of the things that we're seeing in our research is we're going to be lowering our U.S. overweight position and moving closer to neutral and moving some money into the non-U.S. world. There are some select places around the world. If you can either do countries or individual stocks, there are some very interesting opportunities outside of the U.S. When we look at stocks versus other assets here in the U.S. versus bonds and cash, more defensive type instruments, we have been and continue to be overweight stocks versus both. So it's been our view that investors should be lowering their cash levels to the lower end of what they would consider their comfort range based on your own personal mandate and risk reward outlooks and how you view those things. We also believe that if investors still have excessive bond positions, they could be risky at this point, as we are expecting interest rates to move higher, which should hurt those bond type returns. So again, we are overweight stocks. Large versus SMID. I get a lot of questions on this when I do my calls with institutional clients. Now, similar to my global view, we have been overweight large cap stocks versus mid cap stocks for the better part of the last 3 to 5 years as well. What we started to see last August, September, and is still continuing now, is that my research has suggested that investors need to start moving down the cap scale, meaning we want to start leaving maybe some of those larger cap names, which have been some high flyers. A lot of them are in the technology sector, and moving down the cap scale. And there are a lot of wonderful investment opportunities in what we call the SMID cap space, which is for small and medium-sized companies. Generally, offense versus defense. When we go forward and we look at our sector positioning, one thing that'll be clear is we definitely favor things that we're generally thought of as being more offensive in our work versus defensive areas. So again, we want to position to capture these sectors outperforming the market if we do indeed get some of the things we were looking for from our macro assumption page. As we drill down even deeper and we look at different styles, and you may hear this in the headlines or other experts talking about it, you may hear what we call styles: growth versus value, FANG stocks versus cyclicality. And so one of the things that we're doing is, last year we had suggested that investors have a balanced portfolio, that we wanted to have what we described as a barbell, some growth and some value. What we started to see, similar to that small versus large, late August, early September, was this shift in our research that suggested that we needed to start moving more aggressively towards value. Now, we're not selling all of our growth and we're not moving out of every technology stock, but we have lowered our exposure or weightings, and we wanted to move into things that are more value and cyclically oriented. Those are the big picture conclusions on how we think an investor should be thinking about their portfolios and where we want to have more and less weight. The next thing that a lot of people ask me questions about is what we call S&P targets. And a couple of things that are in S&P targets. We talk about the level of earnings for the S&P 500. We talk about multiples, which is another way of saying what should the fair value valuation range be on a price to earnings basis, or what we call PE. And then how do we get to our ultimate year-end price target for the index? So I like to break these down into a couple of different pieces here on page number 13. So the first thing I wanted to point out here is that we expect earnings for the S&P 500 to be $178 for 2021. Now, just to put this in perspective, the year 2020, which is just right now going through the fourth quarter earnings reports, 2020 should end the year around $142 to $146. So that would mean that we're expecting or forecasting a 25% year-over-year growth rate in corporate profits for the coming year. For those of you that are unfamiliar with the history and the growth of corporate profits, the long-term average for the S&P 500 is roughly around 7%. A good year for S&P profits would be 10 to 12. And if we were normally coming out of a recession bottom, not what we had last year, which I'll broadly call maybe a forced depression, you may get 15 to 17% earnings growth. So to get 25% earnings growth year over year is a big number. And again, something we talked about earlier on, of this corporate profit recovery story. Now, that level for earnings only assumes, again, a moderate stimulus package. If we get the larger figure that has been thrown around, the risk to my earnings number will be to the upside. We also are putting out a preliminary estimate for 2022 of $205. Now, the earnings is important because for us to calculate a PE ratio for the market, we need that earnings number. So that's one important component for us to get our target range. The next thing that we think about is that operating margins for these companies in corporate America, as the top line or sales levels begin to return to pre-COVID levels, companies during this period have been streamlining their operations. Either it's cutting costs, watching their head count, watching inventory levels and other things. So one thing that's happening is as sales begin to return, the level of profit that they get on that level of sales will likely be higher now than what it was last year. And again, that's going to be pretty powerful and help this profit recovery story. When we look at valuation levels, and that third point, you may be reading and hearing about the S&P 500 or equities in general are overvalued, that we're in a bubble. Our research suggests that that is not the case at all. We've done a lot of deep research on this topic, and one of the things that we have to look at is other factors. We just can't look at the level of a multiple or P ratio. We have to look at other things, and three of the most important things that my research suggests that we have to consider would be: number one, inflation expectations; number two, interest rate expectations, and if we put those two together, we get something called a real yield. And then we also have to look at where is Fed policy. Where are we? Are we still accommodative? Are we moving towards more restrictive? And that tone from the Fed has worked its way into fair value. Now, when we look at those three important factors, our view is that all three of those are still at all-time favorable readings. When we incorporate that now into our models to predict where fair value should be on the S&P 500, our work thinks that the PE multiple should be between 20 and 22 times what we call forward earnings. So we're looking for what the earnings will be in the forward 12 months. Okay, let's put that in perspective for 1 minute. The normal range for S&P earnings is between 12 times and 17 times. So yes, our expectation is for the multiple for the index to be at or above all-time highs. Our research would suggest when we make these proper adjustments for interest rates and inflation and the Fed, that number actually makes sense. So we're not as concerned today with the level of valuation as some of the other forecasters you may hear from that are concerned about valuation levels. Ultimately, that will become a problem, but we do not believe that that's the problem today, on February 26th of 2021. So for us to now get a year-end price target, to think about what is the potential for the index as a whole. Very simply, we take our earnings number and we multiply it by our multiple range. So if we take the 22 times earnings for 2022, which would be the forward 12-month number for year-end 2021, we get a potential range for the S&P 500 to be between 4,100 and 4,510. So if the S&P 500 today is trading at 3,800, we can see that we have upside. Now, that doesn't mean every stock in the index goes up exactly the same amount, or areas go up in the same amount. There are going to be certain parts of the index which will go up a lot, and certain areas which may go up a little, or some parts that may actually go down. So we think that there's a lot of potential. Now, as I pointed out earlier, my earnings number could actually be low. Number two, very rarely do indexes stop at what I would consider fair value multiples. Markets have a tendency to trade above and below those fair value multiples for sometimes significant periods of time. So we could actually get an overshoot on the multiple, and if my earnings number ends up being low, that potential for the S&P could be higher. We're not going to make that our base forecast today. It's not going to change how we would position today, but there appears to be potential that my target range for the future may be on the low side. As we move forward here, let's set the table now. Let's get in a little more details. Where are we, as we were starting the year, and where are we now in the year? So one of the things we look at here on page 15, as the year began, as I mentioned, the Fed is very accommodative. U.S. equity markets from, we'll call it a technical analysis level, was a bit extended. You may have even heard the term overbought. At that time, interest rates are low, but they were drifting up. The COVID cases were still pretty widespread, and the vaccine deployment was, going a little sluggishly. And the U.S. government is still in the early phases of this Biden administration. The government is still transitioning. So that's kind of our starting point. Now let's look forward and see where we might be going. So when I started talking about 2021, we started looking at two main scenarios. And I think right now we're actually getting very close to what I'll describe as a tactical crossroad. And so we see two potential paths for the market. The first scenario is what I'll call the bearish crossroad path initially. And if you notice here on this graphic, and I'll use my pen for the first time here, and we look at this over here, one of the things we're looking for here is there is a potential for the market to have a correction sometime in the first half of this year. And one of the things that we would be looking for an equity market correction would be some of the road signs that we see in that gray path. And some of those are that the COVID cases actually start going back up again, that the vaccine deployment just can't really get going, and we're not getting enough vaccines in people's arms to really make a difference. That the administration does not get a $2 trillion stimulus passed, maybe ultimately because of a very, very tight Senate, maybe that number comes in closer to 1 trillion or 900 billion. If that happens, I don't believe tactically the market will like that. If we get any of those three things, or if we get all three, our view would be is the U.S. equity market would likely have what we would describe as a very healthy, well-needed 5 to 10% correction. And one of the things we'd be looking at, if you consider yourself kind of a strategic long-only investor, we would probably just play through the dip and look to do some buying when we got towards the low. If you consider yourself a trader, we're going to try to identify the top so we can protect, trade that, maybe go short, and try to play that dip and then buy at the bottom. But that's only if someone considered themselves very nimble and someone who can do things like that. The other scenario that we talk about here, that's one scenario we've been looking at. The other scenario is what I'll describe as the more bullish short-term scenario. And one of the things we're going to talk about here are what would be the things that would make up, this more bullish scenario. But one of the things we're looking at here actually looks like what's happening. So the COVID cases have actually come down quite a bit, and some might even use the word dramatically coming down. The vaccine rollouts after the original bumpy start that we had in late December, early January, is starting to pick up. And it looks like as the vaccine makers start to replenish inventories, that should continue to be the case. And as of today, it actually looks like fiscal stimulus may be on the larger side. This is what we call the bullish path. And it looks like for us, that things are tilting this way. So what would we expect in this scenario? We would expect the S&P to kind of thrust ahead. I think once we get past this little interest rate episode that we're having over the last week, the S&P 500 should make its way above 4,000. Strategic long-only investors should clearly be positioned to try to take advantage of this. And tactical traders should also be raising exposure aggressively as they're going to try to trade this. For right now, everybody, this is where most of the data looks like it's coming in. So again, we're positioned right now for more upside to take advantage, of this scenario that we're looking at. So as I look here to turn the page and move forward. So right now, as I said, it looks like we are indeed tilting towards this more bullish path. But I wanted to just take a minute just to talk about for 1 minute so people can be prepared and think about things. If the road signs start to show up for the more bearish case tactically, what we want to think about it. And I've really talked about this. If you're a longer term strategic investor, you don't like trading your portfolio, you don't feel you have an edge in doing so, you want to invest for 1 to 3 years into the future. It's our view that the pullback probably will not be big enough or long enough to sell the top and then reposition by the bottom and get both trades right. That can be tricky even for a professional investor. So we've been advising, mutual fund managers and people out there that I talk to that manage 10, 20, $40 billion that, sometimes we just play through these weaker periods and be a long-term holder, and you'll be rewarded because ultimately we think there's going to be further gains on the other side. If, however, you consider yourself more nimble, you can trade, you like to trade, you like to catch every wiggle of the market, so to speak. We do think for an aggressive trader that this move could be playable. You're going to have to be very quick to take advantage of it, but we're going to try to identify in my research when that does happen, because I do have clients that are aggressive traders, to try to take advantage of what we think a pullback. So as we think about this bearish case, again, we don't think it's going to be like the end of a long-term bull market. It's going to be a very normal, regular correction in a longer-term uptrend. So we just want you to think about that, because we're probably going to have one during this calendar year at some point. And we don't want people to overly agitate about it, get upset, or worry. We want you to be properly positioned so we can take advantage and have good returns. So one of the things I'd like to do now, as we've talked about that, is kind of move forward and get more into the weeds a little bit. We talked about general tone for the market, but how should investor be positioned? What parts of the market can actually do better than others? So here at FSInsight and in my product here in Portfolio Strategy, we have what I call a lot of process tools and models that we use, very objective tools, to help us figure out and gauge risk and reward in different areas of the market. So how do we do this? And I want to talk just a couple minutes about methodology. I think it's very important to have a process, a discipline. When do we buy? When do we sell? To take some of the emotion out of investing. What I have found in my experience of talking to some of the best and brightest investors around the world for the last 20 years is when we take emotion out of our decision making, our returns generally improve. So one of the things that we do is we have what I describe as a multi-factor approach. It's very disciplined, it's very rigorous. And one of the things that I look at, which is most important, is I do a lot of work in what I'll call is analyzing profit or earning cycles. So we're going to start to talk about this. So some of this terminology may not be familiar to some of you. I'll try to do my best job to keep it, more simplified. But it's very, very important. And I think these are important tools that institutional investors use. And I can tell you, if you can appreciate this and use this in your decision making, it will likely help your performance. You're going to hear me start to use a term. How do we analyze these earnings or profit cycles? Well, we have a proprietary indicator, which I call Analyst Sentiment Measure, or acronym ASM. I just wanted to introduce this here because as we move forward and we look at positioning, I'm going to be using this term quite a bit. So remember this term, Analyst Sentiment Measure. And this is a way that we look at profit cycles, or you're going to hear me introduce another word here called earnings revisions. Okay. I'm going to leave this in the packet on your screen, and I don't know if everyone's going to have the ability to get this slide deck, but we have what we call, this is what I call an earnings revision cycle. And one of the things that our research shows that every area of the market, from a stock to what we call a sub-industry, a sector, a market, a country, one of the things that we see is almost everything has what I describe as a natural profit cycle. And what we find is that these profit cycles is they oscillate from high points to low points over time. As you can see here on the screen, kind of this wave where we go down and we come back up again. And knowing very objectively where we are in a profit cycle can be very valuable information towards A, should I have money in the market? And B, if I do have money in the market, what parts of the market do I want to be in? Should I be in healthcare? Should I buy a beverage company? Should I buy a semiconductor company? What we find very strongly in our research, if we can very objectively determine where areas are in their respective profit cycles, it's incredibly valuable information to know how we should position our portfolio. So, if you come over and you become a user of the FSInsight products, one thing you'll see more and more of this, and I welcome you to do that. So where are our sector and industry thoughts right now using some of these tools? These are some of the sectors that we're looking at right now, and you can see here, what our research is suggesting should be a positioning if you're looking at either individual areas or if you're trying to build a portfolio. These recommendations are based on a very disciplined process, which we're going to show some exhibits in a minute of how we get there. So this is kind of what we've been focused on and talking to clients about. On this page 28, I just wanted to point out is the areas that we like or our sectors of interest. You can see that these sectors can be purchased as they are. They are ETFs, which broadly represent these particular sectors. And you can see the tickers that I included there. And one of the things that we have on our FSInsight website and product is we have a sector allocation model, which clients will get used to. And we start to suggest to clients, this is how we would build a portfolio. How much weight should you have in each of these areas? These are the areas that we are particularly focused on right now and that we like. Why do we like these? Well, in a minute, we're going to start to talk about some of the tools that we use. Okay, as we turn to page 30, you're going to see this wild setup here with lots of charts on a page. Not to try to be overly intimidating here, but this is the basis for how we determine if a sector in the market is favorable or unfavorable. We call this setup here an 8-panel analysis, simply called that because there are 8 charts on the page. One of the things that we find is if we put all areas of the market, sectors and the subcomponent of sectors, which we call sub-industries, which is getting more granular, it's moving closer to stocks, but it's still a group of names, not an individual name. What we find is if we can put all areas of the market into this similar construct, a very disciplined, objective setup, we can determine risk and reward opportunities in the market. So I'm going to take 1 minute and just explain a couple of basic concepts, maybe just to whet your appetite, to maybe have you come over and look at the more detailed information at some point. But one of the things we're going to talk about here is something that I mentioned earlier, which were those earnings revisions. And you'll notice here we have this acronym ASM. And if you remember from earlier, I called that analyst sentiment measure. And again, what we're looking at here is we're looking at profit cycles. What is the analyst community who covers individual stocks? What are they doing with their forward profit expectations for individual companies that are in the group that we're looking at? And right now we're looking at the overall consumer discretionary sector. And what these analysts do every day, everybody, is one of their responsibilities is to forecast profits for the companies they cover for the future. Is this company going to make money? Do they have new products coming out? Will they benefit from the economy being strong? Will they be hurt by the economy being weak? And they make these profit forecasts. Now, once they make those profit forecasts, as they move forward, they then change them. Either they raise or they lower them. We call that an earnings revision. Why that's important is we have found if we take all these analysts, so let's just say for one company like Amazon, there may be 40 or 50 different analysts on Wall Street that cover Amazon. And all those 50 individuals are all changing their respective numbers and outlooks for Amazon almost every day. What we have found is that we can capture that information and we put it into our model. What we can find is that we can determine where we are in the expectations of a profit cycle. So one of the things that we find is that, as we said earlier, almost every area has a profit cycle. So one thing you'll notice here for this discretionary group, you'll notice this line goes from high points to low points, back to high points. It goes back and forth. What we find is in our model, without going into too much detail about what goes into it, is that when there's too much optimism on Wall Street, or when those earnings revision levels are at very high points, this is generally when we want to sell. Now, that may sound counterintuitive to you. Why do you want to sell good news? Why do you want to sell optimism? Well, at some point, the optimism for a stock, a sector, or maybe even the market, all that good news gets priced into a stock or the idea we're looking at. And once it gets priced in, it's not a very good investment anymore. Same thing on the other side. When all the bad news gets priced in, we're at these lower levels down here. If all the bad news is in a stock and everything from that point will get better, that's a great place to possibly be looking to buy a stock. So one of the things that we very objectively use in this methodology is we're trying to identify areas where expectations are too low, or said another way, when Wall Street and investors are overly negative. That's when we want to buy. And when people are too overly optimistic, we generally want to sell. Now let's look at how this worked in real time for a minute. As you think back to last year, COVID starts to hit the front page of the newspapers. We start to go on forced economic lockdowns around the world. As you can probably imagine, the earnings expectations for any company that is tied to the economy, their profit expectations plummeted. They went they got cut and they fell into a very low level. Well, interestingly, our research started to see what we call less bad or too much optimism in this metric here beginning to get better as early as March 20th of last year. So I want to say that again. Our work turned what we call bullish March 20th of last year. Now let's think about that. There was still a lot of uncertainty in the market. Nobody knew where COVID was going. The central banks hadn't really acted very aggressively yet. In our research process, we started to get these signals that the bad news was priced in. And we made forecasts that it was time to start stepping up and buying these stocks because they had been hit too much, and it was time to start buying. As it turned out, that was a very good call. The market went up. We helped our clients make very good returns last year. So one of the things that we offer you at our firm is this type of objective analysis to try to determine parts. So one of the things I'm going to just do quickly here are some of the sectors. One of the things you'll notice that every area that I like, if you look at this ASM line, you'll notice that it's positively sloped and rising and not yet at what we call an extreme level. If you come over to FSI, I'll get a chance to explain to you everything else that's on this page, but this earnings line is really the most important in our objective process. So as I move forward here, the other thing we're going to show you here is, so consumer discretionary is an area that we like. Industrial names, again, look at this earnings revision turn that we got last year around that end of March period. And this line has been rising up and continues to work its way higher. Here is the material sector. After having several years of this earnings line coming down and being weak, again, notice it went right down to close to its lower boundary. We got what we call the second derivative turn or inflection point in that name, as we see here on the screen. And this line is now rolling up. You know, setups like these are normally very positive for returns and names in these spaces. The financials, again, here we go. Notice here that the financials, this earnings revision line is beginning to kick back up.
Brian, it's Andrew. Looks like we've got a bit of audio interruption there. We've just dropped down. Can you hear me?
Yes, I can hear you.
Brian, we've lost your audio momentarily.
Do I need to do something different? Because I see everything working on my end.
Sorry, folks. Looks like we've momentarily lost Brian, or at least his audio. I can see his.
Hey, Andrew. I have one of my team on the line. Andrew.
Maybe Brian, you can. I can see that you're trying to talk, Brian, but you're not coming through.
Andrew.
Okay, so it looks like.
Andrew, if you can hear me.
I'm sorry, Brian. Continue.
Yeah, for whatever it's worth, Andrew, I have one of my team on the line. He says he heard everything we were saying, so at least the people in the audience can still hear. Okay, so as we were saying here, that the financials, this earnings revision line is what we call positively sloped and rising, which is one of the reasons why we shifted our positioning into the financials. One of the things we've been looking at is the banks, particularly. The technology space, believe it or not, we are not at what we call an extreme level, although certain areas of the tech space are maybe getting what we call at the north end. But broadly, the sector still looks okay. So we still want to have some weighting with it in the technology sector. So as we turn our attention here into getting closer to stocks now, I have this very big table here. One of the things I would advise everybody to think about is, as you think about your portfolios, you know, if you want to get more granular, is within every sector, as we have a diversified portfolio, what my research is trying to identify is what area within every sector looks to be the most opportunistic, and which areas tend to be the areas that we either want to avoid or not have exposure in. So regardless if I like or I dislike a sector, within every sector, we still may have some exposure, some individual names. So I'm not going to go through this table in detail. Again, if you want some more of the details, again, will be available at the FSInsight. But one of the things we have here for your review is every sector, and what we call is the things that are favorable, things that we think there's going to be more winners and losers, and the areas that we think are unfavorable, the areas within every sector that, you know, we're either having low exposure or no exposure at all. So it's a very detailed page. You can see as we're now going from the market down to sectors, into sub-industries, and the next thing we'll want to talk about is, you know, getting into the stocks itself. So this is how we want to think about building a portfolio overall. As we move forward, one of the things I did today, and I get these questions on all our calls, is if we could highlight some large cap names using our methodology. The methodology be a little bit different at the individual stock level. What are some individual stocks that look interesting in our work? So these are some of the names that look favorable based on our work, not the only ones, but these are some names that I have been talking quite extensively about to institutional investors around the world over the last several weeks and further. One of the names you may see, so we're going to see a new chart set up here. So again, don't be intimidated by the chart setup. So this stack chart is for one individual stock. You'll notice here that this happens to be for a stock called Occidental Petroleum, which happens to be an energy company, and it is within the S&P 500. So one of the things we're going to look at here, and again, just to try to simplify this for now, just to give you guys a flavor for what we're going to do, is this second chart down, and you'll notice here the same acronym that we used earlier, ASM, stands for Analyst Sentiment Measure. And to keep it simplified for today, this metric at the stock level also does this cycling from high points to low points over time. Generally speaking, when this ASM line gets into this lower points and begins to rise, and you'll see up here where we have our computer scoring, usually we see this either being green or black, which are our two favorable readings. We will have a favorable outlook on that stock. So I've listed a couple of names here. I'm not going to go into super detail. I just wanted to give you a little bit of flavor. But the names that we've been highlighting, in a bunch of different areas before I wrap up and turn this back over to Andrew here. These are some of the names I wanted to leave you with today. As you can think about, as we leave our presentation. So the first name would be Occidental Petroleum. The next name is called Vulcan Materials, ticker VMC. And again, you'll notice all these names, the commonality here is that this earnings line will be positively sloped and rising. Another name that we're looking at very favorably is Hilton, a hotel name, obviously being hit by COVID and lockdowns and the lack of vacationing and travel around the world. But this is a name that our work looks at very, very favorably here, as this earnings line is getting what we call less bad. It hasn't even gotten to good yet. And we think that once it does get into this northern hemisphere and these green bars return, it's going to be a great stock. Another travel related name, a little bit smaller, I wanted to throw in there, would be Vail Resorts, obviously the mountain. And again, what do we see here is that this earnings revision line here is rolling upward, positively sloped. Another name we like is Darden Restaurants. Obviously, if we start to come out of lockdown and foot traffic begins, people will likely begin to start eating out again. And we feel this is one of the names that we want to be positioned in among several other restaurants. Cooper, this is in the healthcare sector. You noticed earlier, if you remember what the sector table looked like, is that we don't like the healthcare sector as a whole. That does not mean we want zero healthcare exposure. There are a handful of names within the healthcare sector which we would gladly be owners of. Cooper is one of them. And again, you can see here why this earnings revision line is positively sloped. The stock is acting quite well. So Cooper is a name which we particularly like. Page 44 happens to be one of my favorite stocks. It has been for quite some time, and I've advised all my institutional clients that this name, Walt Disney, ticker DIS, should be a core holding, in my opinion, and based on my research, should be a core holding in an investor's portfolio. I really like the stock. The work really likes it. Again, you'll notice here this ASM line really beginning to get positively sloped here. Should clearly be a beneficiary of when lockdowns start to end. Another name, which is a little bit smaller, maybe, I don't know if you know this one, it's called Live Nation. They are, from my understanding, that they get involved in selling tickets to events, concerts, sports, and the like, which have clearly been impacted because of COVID. And one of the things we're seeing here is that this earnings revision line, again, not as strong as Disney yet, but it's beginning to roll up. So we like this name. So those were some names I wanted to highlight to you today. Again, my research likes them. Obviously, for each individual name, look at your own personal risk-reward profiles to see if they are possibly appropriate for you. But those are things that my research generally likes and say that you should take a look at. So to wrap up, before I give this back to Andrew, our final conclusions today are, we're staying bullish. Our research is supportive for higher equity markets. We are looking to buy tactical weakness. So, we had this period in January. We've had this period that we're in right now. We're looking at these opportunistically. And again, we have a bias towards what we call value and cyclicals. And we also are, looking more thoroughly to move down what we call the cap scale from those larger names into some smaller names. So that's the conclusion for today. I did want to say thank you for participating. Hopefully that was insightful to you. Again, if you want more details and to look at our full product suite, we're at FSInsight, and I will turn this back to Mr. Andrew Wilkinson, who's been very helpful today in moderating our call.
Brian, thank you very much. A very insightful webinar. And my apologies for the interruption halfway through. My computer threw a hissy fit and cut your audio out. And what was going on there was my microphone was interfering. And thanks to everybody for letting me know that. And I managed to get it resolved. Fantastic presentation, lots of information there. Today's event is going to be posted to the IB website later on under the Education and Webinars tab, and look under the industry sponsored, and we will post the notes there to this event there, and we will also post this to the IBKR YouTube channel. So any subscribers to that channel will automatically receive the update. Brian, there were some questions. I'm going to forward those on to you so you can get back to people, because we're rapidly running out of time here. I just wanted to make everybody aware. There was or today, I think it wraps up, there was a free subscription to FSInsight, and to get to the news wire from FSInsight from the new window button in Trader Workstation, you'd come down to Analyst Research, and you'll see up at the top I have these are all the things I'm subscribed to automatically. There's FSInsight. That will disappear over the weekend, and it will appear under the available selection underneath. But if I had to click that today, you'll see the wonderful news coming from FSInsight on a daily basis, and this is all currently available. If you want to do some reading over the weekend, you can click on those links and access that report. Otherwise, next week you're going to have to go into your client portal and you go to the settings and user settings and subscribe to FSInsight. So weekend reading there for you. So once again, Brian Rauscher of FSInsight, thank you very much for joining us today. I hope that we'll have a chance to get you to come back onto the platform at some point. I'm going to hand over to you to wrap up, and I'll say thank you to everybody else for joining us, and look out for the recording later.
Great. Well, thank you, Andrew. I appreciate it. And everybody, I hope you enjoyed the call, and look forward to maybe doing it again.
Thanks, everybody. Thank you, Brian. Bye now for everybody.